Welcome to Section 4. Non-controlling interests are one of the most frequently mishandled areas in consolidated financial statements, even by experienced teams. The rules under a SC 810 changed significantly from the old minority interest guidance, and several common mistakes persist. In this section, we will cover where NCI sits on the financial statements, how income and losses are allocated, what happens when the parent sells some shares without losing control, and the one NCI rule that surprises almost everyone. By the end of this section, you will know exactly where NCI appears on the balance sheet and how net income is split on the income statement. You will understand how a SC 810 handles losses that exceed the NCI balance and why this differs from the equity method. You will be able to record dividends paid to non-controlling owners. You will understand why selling some shares to a third party while retaining control is an equity transaction with no gain or loss. And you will be able to avoid the most common NCI presentation mistakes. When a parent company consolidates a subsidiary it does not own entirely, the remaining ownership stake belongs to somebody else, the non-controlling interest holders. These are real shareholders of the subsidiary with a genuine economic stake in the consolidated group. Their shares, their claims on the subsidiary's assets, their share of the subsidiary's income, all of that is real. A SC 810 requires that this ownership be properly reflected in the consolidated financial statements, both on the balance sheet and on the income statement. Getting NCI wrong distorts the picture of who owns what and who earns what. This is where many teams get it wrong, often because of old habits from pre-2008 guidance. Under current ASC 810, non-controlling interest is presented within the equity section of the consolidated balance sheet. It is clearly labeled and separate from the parent company's equity, but it is inside equity, not below the liabilities, not in a mezzanine section between liabilities and equity. Inside equity, NCI holders are owners, not creditors. They have an equity claim, not a debt claim. The balance sheet must reflect that. If you see NCI sitting outside the equity section on a set of financial statements, that is a presentation error. The income statement treatment follows the same logic. The consolidated group's total net income is presented first, combining the parent and all subsidiaries. Below that single consolidated number, the income is split into two parts, the amount attributable to the parent's shareholders and the amount attributable to the non-controlling interests. Both lines appear below consolidated net income. It is not that NCI is deducted from income. It is that income is allocated. The same principle applies to other comprehensive income. OCI is also split proportionally between the parent and the NCI holders. Here is the rule that surprises most people. Under consolidation, non-controlling interest absorbs its proportionate share of the subsidiary's losses, even when those losses exceed the NCI balance and push it below zero. If the subsidiary has a bad year and the NCI's proportionate share of those losses is greater than the NCI balance in equity, the NCI balance goes negative. This is fundamentally different from the equity method, where losses stop being allocated once the investment reaches zero. Under a SC 810, there is no floor. The NCI follows the subsidiary's performance wherever it goes. A negative NCI balance on the consolidated balance sheet is technically correct. When the subsidiary pays dividends to its non-controlling shareholders, that payment reduces the NCI balance in equity. It is not an expense. It does not touch the income statement. This is consistent with how dividends paid to any equity holder are treated, as a return of equity, not as a cost of doing business. The journal entry is simply a debit to the NCI balance in equity and a credit to cash. The consolidated income statement is unaffected. This distinction matters for anyone reading the consolidated statements and trying to reconcile movements in the equity section. This is another area where the pre-2008 rules created persistent bad habits. Under current ASC 810, if the parent sells some of its shares in a subsidiary to a third party but retains a controlling interest, that transaction is treated as an equity transaction, not a disposal. No gain or loss is recognized on the income statement. Instead, the NCI balance increases to reflect the new owner's stake, and the offset goes to additional paid-in capital. The logic is clean. The group still controls the same assets and liabilities. Nothing about the consolidated group has changed in substance. What has changed is the distribution of ownership within the equity section. Tracking the NCI balance through the period is straightforward when you follow the roll forward. Start with the opening NCI balance. Add the NCI's proportionate share of the subsidiary's net income for the period. Add the NCI's share of other comprehensive income. Deduct any dividends paid to NCI holders during the period. Add or subtract any equity transaction adjustments from ownership changes. The closing balance should tie to the NCI line in the equity section of the consolidated balance sheet. Auditors routinely request this roll forward as support. It is a fundamental piece of the consolidation work paper. Let's call out the four most common NCI mistakes directly. First, presenting NCI as a liability. Incorrect. NCI is equity. Second, placing NCI in a mezzanine section between liabilities and equity. Also incorrect. NCI belongs inside equity. Third, stopping loss allocation when the NCI balance hits zero. That is the equity method rule. Under consolidation, losses continue to be allocated to NCI even below zero. Fourth, recognizing a gain or loss on the income statement when the parent sells some shares while retaining control. No gain or loss, equity transaction only. Each of these mistakes has a specific root cause, and knowing the rules helps you catch them in work paper review. To summarize non-controlling interests, NCI is always presented within equity, clearly labeled and separate from the parent's equity. Net income is allocated. Total consolidated income is presented first, then split between the controlling and non-controlling interests. Losses are absorbed by NCI without a floor, even if the NCI balance goes negative. Dividends to NCI reduce the equity balance without touching the income statement. And ownership changes that do not involve loss of control are equity transactions with no income statement impact. In the next section, we tackle intercompany eliminations, how to remove all the transactions that happened inside the group before consolidation is complete. Thank you for completing this section on non-controlling interests. Thank you for watching. Subscribe for more training from PNJ Group.